Howdy there, folks. Welcome into the Reaction channel. Got an interesting video to watch. This is Ray Dalio's right-hand man at Bridgewater, okay? I've only watched part of this so far. I've watched kind of like the first half of it, so we're going to watch the whole video together here, and I'm going to react to this. In this video, this gentleman right here kind of makes a prediction of a 3-year recession, okay? So we're going to hear what he has to say about that, and he kind of frames it in a few different thoughts that I think are important here, okay? Now, when you hear things like 3-year long recession, when you hear things about like what we had to talk about on the main channel yesterday, which was this thought process of being a lost decade, right? A lot of scariness. And you got to understand the cycle we're in the market and the psychology of the market we're in right now, right? You know, stocks have been crashing across the board. Fed's raising interest rates like crazy. We've had sky high inflation. We've had a lot of things go wrong. And so when you talk about, you know, as of right now, I think the NASDAQ's down around 32% year to date. You got to understand when you're in those sorts of years, you know, stuff's going to be thrown out there. And if you go back to 2009, let's say, for instance, and you were to take everybody's predictions about how bad the economy was going to get and how many years it was going to take to even get close to recovering and all those sorts of things. And if you look at 2020 and you pull up everybody's, you know, opinions about March of 2020, oh my gosh, okay, it was end of the world. So when you're in a major crash, almost everything's thrown out there and you just have to accept it. You have to understand that, right? And then you have to kind of go through it and be like, okay, how realistic is this scenario that they're kind of planning here, okay? So I hope you guys enjoyed this video. As always, thank you so much for everybody for joining me. I think I don't know, maybe this week we hit 14,000 subscribers on the channel. I appreciate each and every one of you for being here. As always, thanks for joining me in this video. And, there's a reason I don't leave the house. That's all I'm going to say about that. 9, 10, somewhere in there, okay? Maybe 9 y 5. Yeah, that sounds about right, okay?
To talk about the choppy macro environment we're in, and then we'll get to, a little later in the conversation, Bridgewater's secret sauce, what it takes inside the investment process for you guys. But starting with the macro environment here, it's been a tough year. And very recently, you've actually also told Bloomberg that the equity market itself has a ways to go when it comes to a drawdown. So when you look at kind of the grand array of risks in front of us, which are the ones that investors today are the most misunderstood?
Yeah, well, when I look at markets, like all investors are thinking different things, but you can kind of aggregate market sentiment just by looking at what's priced in and comparing what you think will happen relative to that. And so I think the biggest mistake...
Real quick, does FTX sponsor literally everything? Holy smokes, man. You can't go anywhere without an FTX logo somewhere. My gosh.
Priced into markets right now is the belief that we're going to return to essentially pricing similar to pre-COVID, that inflation is expected in markets to come down to a little under 3% over the next 18 months or so. And that... that'll happen without much of a recession. So earnings are priced to continue to grow at a relatively normal rate from here. So I think that is probably the biggest mistake being priced in, which is things can revert normally, that we've had the drawdown and the worst is behind us. I think that's actually a mistake. We're still in the early phase of dealing with a radically different world than we had pre-COVID, a world that's deglobalizing rapidly, that's definancializing in certain ways, that is short, still doesn't have enough energy in a lot of places in the world for relative to economic conditions before. And we're working our way through that process. And so just like the phase, you have a 30-year phase from 1982 to 2008 of lower interest rates and higher private sector debt. You had a phase from 2008 basically up to COVID of the shift of private sector debt onto the government balance sheets through quantitative easing. And then you have fiscal policy and monetary policy come together and to create an explosive mix of demand outstripping supply post-COVID that led into this inflationary environment, which is a challenge for policymakers where they no longer can get what they want, which is essentially low inflation and reasonable growth. And therefore they're constrained. And the markets aren't pricing for how constrained policymakers are, how actually impossible what markets expect reasonably good earnings growth and low inflation to come in a combination are. So I'd say that's the biggest mistake.
Well, it's interesting because before a lot of these issues, even
I don't really have too strong of an opinion on that because I think time just has to play out, to be quite honest, in this whole situation. And the point he makes is a valid point in terms of it's, much tougher conditions across the board than pre-Rona, right? And especially when you see, if things were already deteriorating, I felt like between certain countries, really United States and China, way before Rona happened. It seems like it's just taken another leg lower, maybe over the past year or so. And so I think that's something everybody has to kind of factor in. And a lot of folks are expecting earnings to get back on track in 23, and it remains to be seen, right? I think a big part of that's going to be what's the employment picture look like. If we don't see mass layoffs, and see unemployment go to 5% or something like that, or especially above 5%, I think there's a decent probability actually 23's earnings could be pretty strong if we don't see unemployment climb in any meaningful way. And the reason being is I've seen a lot of companies do a lot of cost-cutting measures. And, if they could be in a situation where they can just hold revenue, never mind if they could grow revenue a little bit, I think that would put them in a pretty strong position. But everything goes out the window as soon as you potentially throw in unemployment's climbing. And that's something we all have to understand, right? So it's something to be factored in there. I obviously worry a lot about real estate in 2023. And if homes aren't being built, that's going to cost a lot of jobs, which is going to directly and indirectly hurt the economy in a meaningful way, and I think more meaningful than a lot of people understand.
Came to the forefront. There was a podcast that you had hosted by Ted Seides, and you had a very dire outlook. You said the world is bad for investors going forward. That was before the start of the war. That was before the shift in a lot of the Federal Reserve policies. And a lot has changed, as we said, since then. To what extent do you think that the job of policymakers will get even harder moving forward with some of these great unknowns?
Yeah, well, when I was talking about that in the middle and end of last year, in 2021, the basic picture was becoming more and more obvious that the inflation problem was caused by demand, not just supply, that the Fed combination of macroeconomic monetary policy and fiscal policy had created this thing that the Fed was going to have to face. It was interesting how long it took for the market to price that in. What we were expecting all through 2021 really played out in the first 2 quarters of 2022. But this is the early phase that you actually don't face the dilemma yet. You have a 3.7% unemployment rate. It's easy for the Fed to talk tough about inflation. What I think will happen going forward is you're going to have inflation staying stubbornly higher than markets are expecting as growth starts to turn down. That's when it gets really tricky, and that's what's going to create, in our view, sort of the more risky part of the downturn, when it becomes clear that earnings are falling and rates are still not falling and rates are rising.
So I have a difference of opinion there. I think if you just pull up, where commodities are at right now, these things have been tanking. And that's a huge, huge reason why, wrong one. That's a huge, huge reason why, honestly, things ticked up so bad. Look, if you pull up a year to date on all these, look at what's happened to the price of lumber, right? WTI continues to crash. It peaked obviously early in the summer kind of cycle there, and it's just been tanking continually. And now look at the year to date on this. This baby's basically break even year to date. That's crazy to think how much oil went up at first and how much it's come down now at this point. You look at something like oats. Look at this is oats, right? Yeah, oat futures. Look at how much oat futures have come down. If we look at just the commodity index in general at this point in time, obviously we're massively off of the peak there. And remember, you're going to end up starting to comp these numbers. And so I'm just not seeing it. When you go ahead and you look at the numbers and you think about, we're going to have to comp against these numbers. And why would commodities suddenly come back massively? It just doesn't make sense, especially if you're talking about a weakening economic environment. It doesn't make sense for any of these commodities to come back anytime soon in any meaningful way, to be quite frank. So with the whole inflation story, I think it's going to get a whole lot better before it gets worse. If you look at things like container prices, if you look at things like trucking rates, they've all been tanking for months now, and they're getting more to normalized environments. And so, for Bridgewater, and this is one of Ray Dalio's right-hand man, if not his main right-hand man here, I just don't think they're looking at the data in relation to this. I think they got a lot of good points on many various subjects, but in this particular subject, I'm just, look at the data, look at the numbers. It doesn't add up why inflation would continue to be stubbornly high 6 months out, 12 months out. It just doesn't. It doesn't at all, to be quite frank. So, and then if you're thinking rents are going to continue to skyrocket, I don't think so either. Here's the deal. Look at how many apartments are coming online. Look at how many apartments are coming online and being built right now that are all opening up over the next 6 to 12 months. And look at how many homes are being built right now that are going to be finished in the next 6 to 12 months, right? Some of those people might walk away from because interest rates have gone up so much, and some of those might get filled, right? Well, if somebody is getting a house filled, then they're moving out of their current apartment or current home or something like that, right? So I don't think that's going to continue. So just when you start to add up the data, the numbers just aren't there. And never mind when you got to comp these comps year over year, it just doesn't make sense. So that's kind of my personal perspective. Now, if commodities all of a sudden skyrocket, which the only way that would happen is if stocks skyrocket and everything starts skyrocketing again, right? Then you could be in a different environment. But you would still need commodities to go way above where they were back at the peak of springtime and into early summertime. Think about that for a moment, right? Like way above that so you can continue this insane inflation. You need container costs and shipping rates to go insane. I mean, a lot of these have fallen 50% or more just in the past 3 to 6 months. So, things aren't quite adding up there, in my personal opinion.
The period, if you look at history or whatever, that when you can't get what you want, you face that. And even worse in places like the UK and Europe, where you're simultaneously battling currency weakness, economic weakness, and inflation problems. And I think that the downturn feels big relative to the long wave of assets rallying, but in historical standards, asset prices are still quite high. That decline is quite small, and relative to the change in the underlying fundamental conditions, in our view, there's a lot more to come. So and it'll get scary when everybody thinks it's not a temporary blip, but a more permanent phenomenon. That's when the bottom will start to come in.
Well, yeah, I mean, even into the end of this year, there are a lot of risks, right? You are seeing an energy crisis in Europe today, but weather is not as bad as it could get. You're seeing the midterm elections in the United States that could create even more risk. I mean, how do you bake in some of these things that you may know are going to happen and then calculate that back into your investment thesis? I mean, which of the forces are the most important for investors to be considering in the next 6 months if you believe things are getting worse?
Yeah, well, I think the big picture cycle, right, that there's these big cycles happening and those smaller cycles happen. The big cycles include the fact that we've pushed the world. We had such a private sector focused world that hit its limits in terms of corporate power, wealth distribution, et cetera, and that you've moved to a more government-controlled economy and a more government-controlled world. These things happen in phases. Those big trends of monetary easiness, printing of money, fiscal spending increasing, leading to a higher inflation, and at the same time, those big trends include the deglobalization after a 40-year globalization wave going through deglobalization, Russia coming offline, China more and more becoming isolated, at least from the Western country.
To be fair, Russia's such a small part of any company's revenues. Most of our American companies never did business in Russia. And for the ones that did, for the most part, small percentages of their revenue from there. In terms of China, much bigger deal for some U.S. corporations. But remember, a lot of our big companies have never done business in China or haven't really been allowed, right? Meta comes to mind. Amazon's virtually non-existent in China, to be honest. Google's basically non-existent in China. So I think those are just some things to kind of factor in there. Apple gets a decent amount of revenue from China. It's not even close to being their biggest market. Obviously, the United States is the dominant one. But it's a decent-sized market for Apple, so that's something to keep in mind there.
These are the big trends that really matter, right? Then there's the timing things of what will be the particular trigger of the next wave. It could be the election. It could be some other thing, whether in the winter or whatever. But it
will be interesting to see what happens with Apple in China. And here's the thing. I don't know if you guys saw the news, but basically Apple has been starting to build some of the new iPhone 14s in India. So we'll see what happens there and how that relationship shakes out. The thing is, Apple's employed a massive amount of people in China for quite some time, and has always had almost all their products built in China. But now obviously Apple's been trying to move more of their Mac lineup into the United States. And if we're talking about moving iPhone production to India and more so over the coming years, Well, then is China as incentivized to continue to let Apple operate there? Or maybe they all of a sudden say Apple's being bad or doing this or doing that. They'll make up whatever they want to make up in China. Like literally they'll do whatever they want to do if it fits the government agenda, right? That's just the way they operate over there. So we'll see what happens with that.
And I wouldn't get too focused on, unless you're trading for month and month kind of gains. The bigger picture is you have a very different environment, a deglobalizing, definancializing, higher government world that you have to be prepared for as an investor. And that's where I think it's easier to see over the next 2 years than it is whatever the triggers will be over the next month.
I think that also begs the question. You mentioned that the worst may not have yet been seen. So what does the worst case scenario look like? And how long do you believe that whether it's just the U.S. or whether it's the globe will be facing a tough economic environment ahead, particularly for investors? How long does it go on for?
Yeah, well, it depends a lot on how policymakers play and a lot of randomness in that, right? A typical cycle, though, in an inflationary environment is much longer downturns because policymakers can't respond as they normally would to a downturn. So if you look at history, this would normally be something like a 3-year recession rather than a sharp, fast one because the policy response will be slower to the downturn that's emerged.
3-year recession. Woo-wee, okay? Yeah, interesting. That's all I'll say about that. Yeah. If you saw a 3-year recession, you'd see deflation like we've never seen in the United States. That's all I'll say about that. Like the numbers aren't there over the next year for inflation as it is with commodities crashing. Imagine you tack on a 3-year recession. What are commodities at in that cycle? Give me a break.
And so I would expect it to be longer. Now, it depends. The range on those often, is there a big shock? Does it happen in one big, do you get a crash and a quick downturn in deflation due to that crash, in inflation due to that crash? Or does it get expanded out? I think history would suggest this type of environment is probably longer, more grinding than a crash. But it depends on that. So it's not easy to say, is it 3 years or 1 year? But what the magnitude of it is likely to be large and difficult. And that I think you could say with more confidence than you could for how fast, because it really depends how sharp it is.
And so, that's a horrible scenario he just laid out there. 3-year recession. Insane, okay? Now, for my folks that are obviously stock market investors, which I think everybody that's watching this video right now, you're a stock market investor, a lot of people say, oh gosh, so that means the market's down for 3 years? Are you kidding me? It's already been down for a year. We got to go through potentially 3 more years. Doesn't really work like that. In terms of the market, it usually bounces back way before you ever reach a bottom on the economy. And usually the market's looking anywhere from 6 to 9 months out. So, if that scenario did play out, which is, in my opinion, a very extreme scenario, if you're talking about 3-year recession, that'd mean 2 more years of a down stock market, essentially. Okay. Like I said, that's a pretty extreme example, but you never really know. You have to always take these things into account, and that's why it's never good to get your hopes up about any sort of short-term moves. Obviously, if you're a buyer of stocks and you're young, 20s and 30s, for those of you watching this video, it could be pretty darn attractive to be able to buy stocks for several years at very, let's just call it deflated numbers from what you'd get in almost any other cycle. But also don't get your hopes up too much about that because, we don't usually see things down that far. And remember, his picture there is that inflation is going to stay sky high for potentially years to go in the future. And the math just doesn't add up there. The data does not add up. So
hone into a region of the world. Let's hone in on Europe in particular. Given the energy crisis, given that we've reported over and over that Bridgewater does have that short position in European stocks, given the proximity to the war, how do you believe that this plays out over the next 6 to 12 months? How do you believe that the economic picture changes in Europe? And do you believe that some of these changes will be permanent?
Well, I don't think anything's permanent, but I think that Europe's economy is much more so than the U.S. based on manufacturing and having access to the energy, particularly in Germany, that they had. This is a big jolting shock, like in the end, bigger and more lasting than COVID was for sure. And it has so many different aspects of it, most of them negative. You have the fact that it's going to ripple through not just the energy-intensive manufacturing, but all of those inputs. The impact it has on disposable income, the income it has on exploding government budget deficits as they try to offset the effect on households. So you're going to see a lot more bond issuance into a slowing economy. And pretty much a mini balance of payments crisis is going on, and potentially a large one in the UK's case. And that is a very different dynamic than we're used to in the developed world, where short rates have to rise because of the inflation and currency problem.
I'm 100% in agreement with everything he's saying here. No disagreements at all.
While the economy's collapsing. Now, we've seen that obviously happens often in emerging economies, and it has happened in the UK before, but not, you got to go back to the 70s. But the idea that the UK kind of experiment here, which is, all right, we're going to fund the households on their electricity and we're going to do this. That experiment's been tried, that you're going to print money into a rising inflation environment to offset the negative effects. And odds are it fails. We'll see every loop through these things, you learn something. But that formula is quite dangerous, and the balance of payments challenges that it face. And Europe also faces these terrible choices. In the end, to handle a crisis like this, you either have to crush demand through higher interest rates and lower asset prices, or ration demand through a very strong government hand. Both of those are politically very difficult things to do. So they face this incredibly bad dilemma that the markets are still kind of looking past. And it takes a lot to say that. Markets are really good. It's super hard to create alpha. But if you look at how COVID kind of came as a wave, and really the market reaction didn't happen until it landed in the U.S., that if you take last year, where the problems of inflation and everything were so obviously building and the markets didn't react until this year, it does seem like there's a decent chance that the market's not going to react to the European crisis until it's deeply upon us, which I think is the next couple months. But that does seem to be the case, despite the fact a lot of people are talking about it. It's not like we're unique in talking about it. Many people are talking about it. But if you look at the market pricing hasn't adjusted, mainly because so many of the holders of assets are so permanent. They're so index-based. They're not reacting to even changing conditions that are right in our face.
Yeah, it's amazing. You know, when you look at the European markets, I mean, they've been hit, but considering how rough it is over there, they haven't been hit as hard as you would assume they had to have been hit, right? So let's pull up like the DAX, for instance, 23, almost 24%. Let's pull up the UK 100. Like what? The UK 100, 6.5%. I mean, very strange. That's all I'll say about that. I mean, those markets in itself, I'm just like, how have those, not gone down way more? If we pull up a 5-year here, but see, they also haven't been as boosted. So that's something to factor in. I mean, look at the 5-year. It's only, the UK 100 is only up 20%, 21% in the past 5 years. That's really poor performance. Let's back it up. Can we back it up even more here? Maybe not. Oh, wait, but see, that's only taking it back from May. So I don't know why TradingView has it like this. But anyway, so I guess that would be pretty good performance. It's very strange. I don't know. Things aren't adding up there. You would think it has to be a lot worse as far as the financial markets in Europe than they have been. I don't know. Very strange. So I agree with all his points on Europe in regards to that.
Well, for the investors that,
and I do worry about all companies' earnings that are coming from Europe, because I just think it's a very, very tough environment to do business there over probably the next 6 to 12 months. Certainly, we'll see what happens longer term, but the next 6 to 12 months, and you can even see it in companies' earnings. Like a Palantir is a very good example of how weak the European business is compared to their U.S. business. It's like night and day difference.
The rush to the dollar, or believe that U.S. stocks are any sort of safe haven bid. What do you say to those investors? Is it naive to believe that the problems of Europe won't spill into the United States?
Well, directly, the problems of Europe will spill in because U.S. corporations need Europe. You have a shrinking world in a sense of Russia's offline, China is less online, et cetera. Europe's obviously critical to U.S. corporations, 50% of which revenues are outside of the U.S. So of course, the U.S. can't avoid that. Beyond that, the U.S. has its own incredibly difficult problems. And probably the worst thing for the U.S. is it's priced to be the best. So the U.S. is priced in to be the greatest economy, to be the best economy going forward, and not to have major problems that U.S. pricing, as I said before, inflation is going to fall.
Well, to be fair, it's the best house in the city. You know what I mean? It's like where would you put money? China, that does lockdowns all the time, and they're who knows what's going on over there. We're going to put money in the Middle East. We're going to put money in Europe. Come on, man. What are we doing here? So if you're going to look at things logically, it's like, well, shoot, maybe all the houses are burning, but the U.S. has the best house in the street, so that's where we're going to put our money.
Quickly to 2.7, no recession, no problem. Other countries are at least pricing in problems. Here in the U.S., we don't have that. And the U.S. assets are the most elevated, in part because the companies have been best performing, but also because the liquidity post-COVID got stuck in the United States. So much money was printed, it didn't go all over the world the way it did post-financial crisis for reasons I won't take the time to get into now. But the U.S. is the center of the bubble, of the financial bubble, and it is the most at risk of the pulling of liquidity that's happening now at an increasing pace. And just as the liquidity creation by the Fed pushed assets up much faster than the cash flows in the real economy, the liquidity reduction is pulling the money from the assets that need liquidity. Any asset that doesn't generate its own cash flow to support essentially its improvement in its ability to go up as an asset requires new liquidity. You take most extreme are assets like cryptocurrencies or whatever that don't create any income stream. It requires new liquidity in order to get a new buyer, right? And similarly, in some stocks, something like 40% of the U.S. stock market require new liquidity in order to drive up their prices. Without new liquidity, their prices fall. So, and that's a big trend in markets, the difference between the assets that actually can generate the cash flows to support themselves versus the assets that require new investors.
Given that grand discount.
100%. I mean, that's what we've seen continuously in any. Even if you're a growth stock that continues to grow revenue in this environment right now that we're in, right? It won't be like this forever, but the environment we're in, no one wants a piece of anything that's a money-losing company. We've seen it. All their stock prices have fallen 50, 60, 70% this year, right? Crypto. I mean, look at what's happened to Bitcoin, Ethereum, and then look at all the small cryptos. This is just not that sort of environment right now. It will become again, but it's not right now.
That you're talking about, and especially with the U.S. being kind of the center of the financial bubble, as you say, does that require you to be net short to express that view of the world?
That's a good question, because Ray Dalio and obviously his right-hand man here, they obviously talk down about a lot of stuff. They're always coming from a very pessimistic angle, I've noticed, and if you're coming from that angle, why be long? Why not be short if you're coming from such an insanely pessimistic angle all the time, right?
I think you have different ways to invest, right? There's trying to be a long-term investor in what the best asset allocation is, and those people should be invested and not trying to take even 3 years, 5 years. You got to know that your assets could go down for 5 years. But to have a consistent return stream, to make money in bear markets, and bear markets, even though there have been so few of them and they've been so short over the last 30 years, they can go on for a long time. You can be in Japan and you can have a 20, 25-year bear market. You have to know that's a possibility and you have to prepare for that. Now, of course, in Bridgewater's shoes, one of the reasons I love it is we don't have to be long. We don't have to, our fate does not hinge on what the equity market or the bond market does. It hinges on our ability to predict what the next shoe to drop is. We're just as easy for us to make money when assets go up or assets go down. And certainly in this environment, the environment I expect to last for...
Oh, wait, I want to hit that Japan point because that always bugs me. People bring up, remember Japan? U.S. is not Japan. We're not even close, okay? U.S. has so many unfair advantages. One is the United States is the United States, so we attract many times the best talent in the world because we have the best universities in the world, and it's the United States. Also, we have the most well-capitalized VC space out there, and those VC companies go on to fund many times very unprofitable companies, but they employ people that have very good jobs, okay? And some of those companies hit big and become the next $100 billion company or several hundred billion that employs 50,000 people, 100,000 people, 200,000 people, 1 million people, right? And you've seen that time and time again. And then those companies can graduate and go on to the stock market exchanges, which is we have the most well-capitalized and the best stock market in the world, right? So we have so many unfair advantages that to put us in the same realm or even consider Japan, I hate that. They do that all the time, and especially in every negative market. Look what happened in Japan. You can't compare the United States to anybody, and especially not Japan. Come on, man. The more you do the digging on how well set up everything is in the United States, and I know, on the political side, we always, crap on things, right? But I think you could do that just about in every country. But the more you dig into things, you understand the way our system's set up, you realize how unfair our advantages are against everybody else in the world. And it's just the way it is, man. Never mind when, you got the number one currency in the world by a large margin, and your Fed can basically dictate the moves of other Feds. It's so unfair. You can compare Japan to basically every other country in the world. United States, you can't compare to anybody. You can't compare to China. You can't compare to Europe. You can't compare to Japan. You can't compare to the Middle East. You can't do that. It's almost an uneducated view, in my opinion. You got to dig a little deeper and then start to realize, oh man, the United States is cheating, man. They're on steroids, and that's what we are, and it is what it is. You can complain about it or it's unfair. We set it up fucking well. We set it up very well. That's all I'll say.
Several years at least, the being able to be short, being able to create a return stream that doesn't require assets rising is so critical and allows you the opportunity to prosper no matter what the outcomes are.
So it's the part that I love is the Bridgewater secret sauce, bringing us into your investment process. I learned something this weekend about Bridgewater that made me feel quite inadequate. It's that you read 600 pages every weekend before you come into work every Monday morning. What is in that 600 pages that you discuss every Monday morning that helps you make decisions? What is something that maybe you guys talked about today that made you see the world differently?
Well, if I generalize the secret sauce in the best way is, we have been for 42 years at the hard work of writing down a game plan for every event, of thinking through how would you want to react if there's a war, if inflation rises to this, if growth does this, if gold does that. How do you react to all of those things, right? And having translated that into decision rules that we use to trade the markets, the great benefit is we can spend all our effort on what are we missing, right? And that's what, if you talk about what's going on in the world packet that we do every Monday, 600 pages, it's everything that we're thinking we might be wrong about it. We call it our radar because it's like blips on the radar that could sink the ship. And that leads you to all of these things that we're dealing with that maybe aren't well systemized. So if you deal with the deglobalization and what that means, or you're dealing with the energy crisis in Europe, while we have processes that attempt to deal with these things, living through it in real time, you see, well, I haven't thought about this, I haven't thought about that, I haven't thought about, okay, the UK does the government check in a certain way to offset that. All of those things become things that you say, okay, now I got to work on building those into my process. And then over 42 years of compounding that, because we had the discipline to write it down, translate it into algorithms, and keep improving those algorithms, it takes a long time, but you've suddenly got this incredible process. And that's how we make decisions. We make decisions on a daily basis using the process that we've built, and that we focus all of our energy on what we might be missing and then building that into our process.
Well, that goes to show that over decades, you do have some things where you can build upon the data that you've started collecting the data for decades and are now able to systematize. But for all of the things that are on your radar that you can't systematize, which are you most worried about? What is the thing that you need to really start preparing for the next 5 to 10 years?
Yeah, well, almost everything that we do, it started out seeming non-systemizable. But your brain, somehow you're making decisions in your brain. And all we mean by systemization is forcing you to take out of your brain what you want to do so other people can examine it, so you can stress test it the best you possibly can. And so I do think a lot more is systemizable than you might believe if you follow that process. We don't start with, well, what data can we get? Now let's systemize. We start with what problem do we face?
So he's definitely learned under Ray Dalio. There's no doubt about it. It's like she asked him a very direct question. He's going completely indirect here and trying to explain, it's system with that. It's like, dude, get to the point here. And sometimes these sort of people, you lose focus when they're explaining things like this. It's very frustrating. And then, you totally miss a point and they'll kind of like sneak it in there when you're not expecting
the relevant data so that we can make good quality decisions about that problem. So right now, like the studying of this deglobalizing geopolitical world, that's a huge challenge. How do you get the data necessary to understand that? If you take the growing impact of fiscal policy and regulatory policy across the world. China's been this great laboratory of massive regulatory policies driving economies, et cetera. We've taken a lot of that learning and translating that as governments become more proactive in economies, that we have to get the data to do those things. So I'd say the biggest areas of concern right now are the geopolitical risks, are the risks associated with, let's say, higher government involvement in economies, and how do you build that out, those types of things. Gather the data you need to make wise decisions associated with it, put those into processes that you could stress test, and then manage so that you're not making spur-of-the-moment decisions, but you're actually handling those things. And so being prepared and systematically for things like what if there's a conflict over Taiwan, et cetera, having built out a process to deal with those things beforehand rather than trying to react at the time.
Now,
I love how his frame of mind was on everything negative. You never heard him mention anything about the risk of maybe we're wrong in this situation and the world's not going to end and things are going to go along and stocks are going to do very well and growth stocks are going to come back. There's nothing around that, right? It was just about maybe things will be even worse than what we think, which is obviously their view is already extremely pessimistic. And so as a long in the market, I like when people talk like that and they're only thinking, oh, everything's bad, but maybe I'm not even taking it as bad as maybe it's going to be even worse than I'm thinking, right? That actually makes me feel more comfortable in the market because no one's even thinking about, oh, I think things are going to be so bad, but maybe they're not. And maybe I should be considering that possibility a little more. So, but like I said, it's the sort of market we're in right now. So no one's, everybody's thinking about only the risk and not even like maybe my risk is a little misguided. We'll see.
Talk about a couple of your products over at Bridgewater because you have the all-weather fund, which you've once described as never the best performing asset, but it's always pretty good. And then there's the pure alpha fund. So when you're talking to investors about what they need, what they want to invest in, the hedge fund in the most traditional sense of the world and that protection over those tough things that can happen in the world, or pure alpha, what is it that they want more today of?
Well, I think most investors, like what Bridgewater did, which is an important thought that now more people agree on, but is separating your strategic asset allocation from what we call alpha, from your timing decisions, right? And all-weather reflects a strategic asset allocation, our best thinking on that. And pure alpha reflects all of the timing decisions. So pure alpha, like it takes a lot more energy, a lot more time at Bridgewater than all-weather, where it's kind of like, okay, you create a great balanced portfolio and you have that. Pure alpha is understanding what's next to drop over the next 6 to 18 months and how we could be ahead of those things.
Simple way of saying it is basically it's more of a timing the market type fund than the other one, which is a little more long-term focused.
So they're very different. Most people need a mix. They need a good strategic asset allocation, and then they need to know how to deviate from that strategic asset allocation in a disciplined way. So I'd say that they both just serve very different purposes.
Now, we know you've been fairly bearish on things in the next couple of years, but before we leave everybody, I think it's worth asking, what's the biggest opportunity that you see over the next year?
We've been watching this for 6 hours, and finally we get to maybe the possibility of like something could be good in the world. Watch them answer like with something negative. No, hopefully that doesn't happen. We'll see.
I think there are places in the world, we won't go into our positions per se, but there are places in the world that are having very different cycles than the US, the UK, Europe are. And I think that it's interesting, actually, a lot of places in Latin America where they've had much more disciplined monetary and fiscal policy than the US have a lot of opportunities, have a lot of what the developed world needs, have been held back by the lack of investment due to COVID and other things that made it more difficult. So I think there's areas there that look relatively attractive. It's difficult into a tightening world and a world of rising risk premiums and declining liquidity. It's going to be difficult everywhere. But I think there's areas there. There's certainly areas in commodity assets that have been underinvested in, that are less growth sensitive, that are also reasonable longs as well. And just coming back to the thing I was saying before, there's a big difference between equities that generate the cash to support their asset values and the equities that require the ongoing liquidity. So the first category, we think you could still own at reasonably attractive prices. And the second category is what is most at risk in this type of environment.
we will leave Bitcoin on the table for next year.
Okay.
The cash flow question. But thank you so much, Greg, for your time, and thank you all for listening.
I wanted to hear him talk about Bitcoin. Oh boy, okay, that would have got real interesting. So I thought he brought out some really good points there. Definitely some points that are worth thinking about. I definitely agreed with some of what he said. I disagree with some of what he said, as all things should be in life, a little balance there. So I appreciate that. I hope you guys enjoyed this reaction. A little bit of a long one today. If you're looking to join the private stock group, get access to the Discord chats and speak with all of the shareholders in there, including get access to our private group investors report, our daily report, all the course curriculums. Check out the pinned comment down there. Much love as always, and have a great day.